Did too much private equity money kill the US car wash golden goose? Private equity made 80 times cumulative return with Mr. Car Wash. How come the IPO investors were taken to the cleaners? This is the article and this is the topic I would like to discuss today. And I asked Pavel from Rollup Europe to come with me today to share the research he did, because this article is fascinating. And thanks, Pavel, for doing this.
Glad to be here today, Mikk.
So first, let's start. Why did you decide to write about car washes? Number one, and let's add a follow-up question right away, like what initially made the car wash industry so attractive to private equity investors?
You know, I started writing the article when I noticed celebrities like Jason Derulo and Travis Kelce were investing in car wash roll-ups. So I thought, what do they know that I don't know? And here's like you're literally watching videos on YouTube of Travis Kelce showing up to power wash cars himself at the club car wash locations that he owns. But honestly, the numbers are what really caught my attention. You know, we're talking about a $15 billion market with 60,000 stores. Yet at the same time, it's incredibly fragmented. 80% are still independently owned. Even Mr. Car Wash, which was the subject of our article, who is the biggest player with 500 locations, commands less than a 1% market share. That's like finding, you know, a massive industry that's still in its infancy from consolidation perspective. And then, as I started to learn more and more, we discovered the unit economics, you know, operators claiming 40% EBITDA margins with 3-year payback on new sites. So when you see numbers like that, you have to dig deeper to understand what's really going on. And I'm sure that our readers were, super excited about that.
And, again, I can see why like, search funds might, pick up a car wash or two or build a small portfolio, but, like the private equity has been doing like big things. Why is it like this?
A great question. I think private equity saw the perfect storm of factors that make their playbook incredibly effective. First of all, you've got this massive fragmented market that is ripe for consolidation, exactly what typical private equity funds love. But what really got them excited was the transformation of the business model. As we wrote in our article, car washes went from being transaction-based to subscription-based almost overnight, very similar to software. Mr. Car Wash membership program, to illustrate that point, went from 45% of sales in 2020 to 74% in 2024. And that's the holy grail for private equity, predictable recurring revenue. Plus there were some pretty clever financial engineering opportunities. These express tunnels cost around $6 million to build, but through sale and leaseback, operators could reduce their net investment to just $2 million. So if you buy car wash at 12x EBITDA and then sell the real estate at 6% cap rate, you're essentially creating quite a big multiple arbitrage. And to illustrate that point, I think Leonard Green, the PE behind Mr. Car Wash, figured that out quite early, and they recouped their entire equity investment in Mr. Car Wash through debt recaps by 2019, while still retaining a controlling stake. And as you said, the returns on Mr. Car Wash have been stellar, and that's the kind of performance that gets private equity firms very interested in this sector.
Now I'm looking at the stock, and like Mr. Car Wash, it's the largest car wash operator in the world's largest economy. It is doing $1 billion in sales and $200 million in operating cash flow. It's growing. It's highly experienced acquirer with 100 plus completed acquisitions. Why is the stock not performing well?
Look, I think there are several reasons. I spoke to different people when writing this article. I spoke to a long-only fund manager who recently initiated position. I also spoke to an investment banker who has transacted with Mr. Car Wash on both the buy side and the sell side. I think we need to put things in a perspective. When the company IPO, it was still the ZIRP area. The money was still very, very cheap. The interest rates were still relatively low. And the business model was still very, very sound. What I think the people discovered very quickly was that a lot of these car wash roll-ups, I think the most famous being Zips car wash, were incredibly over-levered. So when the interest rates started to go up, the net income has been squeezed. And I think for Zips car wash, their interest payments at some point were something like 20-30% of revenue, so completely eating up the operating cash flow. So that's number one. Number two is, I think, the prices for car washes have become incredibly high. I've spoken to someone who sold a small portfolio of car washes for 18 times EBITDA. At a time, the bankers were really shocked that anybody would pay that price, yet here we are. And so you have that together with the debt, as I mentioned, just the general macro environment, right? The recession, as the US recession was approaching, nobody really knew what a recession environment means for car washes, the car wash roll-ups of that scale. And so if you combine those factors, you then had a massive re-rating from something like 20 plus EBITDA to 10x EBITDA, which, by the way, sounds like a reasonable valuation multiple for a car wash. So that's kind of, I think, what happened. But a bigger question that we are asking ourselves is that, let's say that you re-rated from, double digit to 10x, should you go back to 20? And I think that's a more important question. Ultimately, for the last couple of years, Mr. Car Wash has not been doing any M&A. They do have head of M&A, but they're telling the market that, hey, we'll buy the car washes for 7-8 times, even though nobody is buying at that price. And therefore, they're just sitting and waiting, instead focusing on Greenfield new builds, which, as the article described, have superior payback, a better ROIC, etc. And so ultimately, you have a very big game in town that is not doing M&A, because M&A is too expensive, is building greenfields, but those greenfields are not enough to significantly move the needle. And so essentially you have a business that is X growth, potentially for many, many years to come, bearing potentially a transformative deal, which kind of where that, 10x or low valuation sits in with me.
Hi friends, quick break from the episode to tell you about our very first and newest sponsor, Spacebar Studios. If you're running a portfolio company or operating inside a PE-backed business, you know how hard it is to build pipeline, shorten sales cycles, and increase win rates without adding a bunch of headcount. That's where Spacebar Studios comes in. They partner with B2B companies doing 1 to 50 million in revenue, acting as a flexible growth team that handles outbound, messaging, and paid media. Their work leads to high ROI campaigns that actually move the needle. They've worked with SaaS, compliance, and enterprise service companies, both VC and PE-backed, accelerate revenue and generate serious demand. So if you're ready to scale smarter, not harder, head over to spacebarstudios.co and check them out. That's spacebarstudios.co and check them out. Now, back to the show. In this article, it says, subscriptions may be dying in SaaS, but in car washes, they are all the rage. So my question is, how is it like economy viable? Because for $25 per month, I guess you have like unlimited car washes. Like how does it work?
So the $25 per month unlimited model only works because of the express tunnel revolution. So these are 150 foot conveyor belt systems that can wash a car in 60 to 90 seconds. So I spoke to an industry expert who told me that the rule of thumb is simple: 1 car per foot of conveyor per hour. So 150 foot tunnel can reliably clean 150 cars per hour. So here was fascinating. You only need 3 people to run a very busy location. 1 at point of sale, 1 in the tunnel, 1 roaming the parking lot. That's how you get to 70 to 80% gross margins. But the real genius is actually in the membership psychology. Customers average 2 to 4 washes per month. And here's the kicker. It's incredible. Many of the cars aren't even dirty. So people wash their cars because they have an unlimited plan, not because they need to. And on top of that, the churn is incredibly low. Only 5% leave after first months. And here's a beautiful upsell mechanism. Mr. Car Wash, to illustrate the point, has 3 tiers: base, platinum, and titanium. Titanium is only $17 more than base and comes with something called Hot Shine Carnauba Wax ceramic coating, which sounds fancy but provides 70% higher contribution margin for the operator. And so the maths of what I describe works out to stores ramping from 1 million revenue in year 1 to 2 million in year 2 with those 40% margins. So it's a pretty compelling model when it works and done properly.
So what about the churn rate? This is like obviously the biggest question in SaaS as well when investing. How about in car washes? Do you have the numbers?
So we were told that based on the expert discussions that 5%, only 5% leave after first month. So, in many SaaS tools, especially the ones that are, PLG self-service, a lot of customers try your tool and then they drop off and go somewhere else. So you potentially have a very high drop off in month 1, up to 50%, and then you could have more or less stable net retention. Car washes are a very, very local business. And so unless there are other car washes in the area, where are you going to drop off to? Because you're not going to drive 50 miles to try a really good express car wash. It costs a lot of money to petrol. It's also time. And therefore, if you position your business in a strategically attractive location. On a side note, we've been hearing that the Burger Kings are being torn down in the US to make space for car washes because economics are much more attractive than franchising businesses. And that kind of illustrates the points, right? If you have a good strategic location with traffic, and ideally not an industrial site, but rather kind of a Horeca type of environment where, you could wash the car, get a burger, drive through, then that's the reason why drop-off point and subsequent churn are often as good or better than software.
In the article again, how Mr. Car Wash struck gold for private equity twice. What and how did they do that?
I think they were operating at the time when they were still one of the pioneers in the whole roll-up sector, right? So they were able to buy sites initially at reasonable valuation before they crept up. The use of sale and leaseback technique to arbitrage and essentially generate capital for subsequent growth. And then ultimately what we find for a lot of these very successful private equity exits, no matter how much your time spent figuring out the value playbook, look at the entry multiple, look at the exit multiple, and it tells you the story, right? It's often that you buy something at a, very, very affordable valuation and then you sell it for 3x multiple. And obviously the IPO was, with the hindsight, overpriced, significantly attractive. But I think by able to, again, do the sale of leaseback, dividend recap, get the cash out early, together with the combination of being able to be the early pioneer in the sector, paying reasonable valuations, a bit of value creation, with the 40% subscription going to 74, potentially, revenue uplift by site through upsells. You combine all of that with a very, very good exit valuation, you get to a very nice return.
Now, trying to understand your own lessons from doing this deep research, and people listening, the question, what lessons can future acquirers take from this car wash story to avoid similar overreach?
This whole car wash saga offers some expensive lessons that future roll-up artists would be wise to follow. First of all, know your radius. That sounds obvious, but the fundamental mistake many aggregators make is assuming that synergies scale linearly across geographies. They don't. One industry insider told me that 80% of customers come from within 8 minutes or less where they live. So the strongest economic moats in car washes are hyperlocal. The same principle applies in many service businesses, dental, vet care, and so on. Second lesson, beware the valuation trap. When Mr. Car Wash saw multiples climbing up in the stratosphere, they pivoted to Greenfield development. In 2021, they acquired 43 stores and they built 11. As I said earlier, by 2024, they were building exclusively and doing 0 acquisitions. That discipline is rare in roll-ups where pressure to show growth often leads to overpaying. Just look at the example of the Amazon FBA sector. Third, and I think this is really crucial, understand the difference between financial engineering and operational excellence. Sale-leasebacks can juice returns in the short term, but they're not substitute for running great operations. Zip's car wash had rent expenses in the low 20% range versus 11 for Mr. That's not sustainable. And they were obviously, Zip's car wash was doing leasebacks quite heavily. I think you need to know where you are in the business cycle. So many rollups are built during periods of cheap debt and favorable conditions. Smart acquirers, they really stress test their models against rising rates, economic downturns, and competitive responses. And in my opinion, Mr. Car Wash survived because they delevered from 8 times EBITDA to under 3. Many of their competitors didn't show that foresight, for example, leading to Zip's Car Wash entering bankruptcy. And finally, perhaps the most important lesson for me is to be honest about your end game from the start. If your strategy depends on finding a greater fool to buy at even higher multiple, you are playing a dangerous game. The most sustainable roll-ups create genuine operational advantages, that persist beyond the consolidation phase. And so, if your model tells you that you need to find a fool just to hit 20% IRR, you're going to be in trouble. But if you're finding a fool to get into the stratosphere, 40, 50% IRR, I think this is a much better and safer bet.
Now, there is this opportunity cost of what to do with your capital, what to do with your time. Do you think there's like a path to successful holding company strategy in car washes, or is there a model, is this model fundamentally broken now? Is it too late maybe?
I think a back to basics playbook for a car wash HoldCo, if I was to build it today, would probably look dramatically different from the growth of cost approach that we saw during the boom years, as Zip's Car Wash illustrates. First of all, I would probably start with a geographic focus. Instead of planting my flag across 30 states, I would probably focus on concentrating in dominating a few specific local markets. As I mentioned earlier, one industry source told me that 80% of customers come from within 8 minutes of where you live, and so the network effects are hyper local. And so I would build the density in my chosen market before expanding elsewhere. Secondly, for me, I think capital discipline is non-negotiable. I think the days of 8 times leverage and aggressive sale and leasebacks are gone, and so a sustainable model would probably have 3 to 4 times leverage with careful management of fixed costs like rent to ensure they are at a reasonable percentage of revenue. And Mr. Car Wash, I think, illustrates the point that if you get there, then you can have a sustainable business model. Third, I think it's really important to prioritize operational excellence or financial engineering. So it really means investing in training programs, maintenance protocols, customer experience. We've actually heard from some industry sources that a KKR bought a company called Quick Quack Car Wash, which apparently is the gold standard in operating excellence, having some of the best margins in the market. And fourth, I think a disciplined approach to growth. That means having clear criteria for both acquisitions and Greenfield development, sticking to them regardless of competitive pressure. As an example, Mr. Car Wash pivoted from acquisitions to Greenfield as multiple roles is perhaps a good illustration. But again, it's very, very difficult in that moment when everyone around you is buying and telling you, hey, we used to buy at 5 times, now the price is 15. It's very difficult to switch and figure out something else. And so this back to basics approach for doing a car wash HoldCo isn't as exciting as the rapid consolidation stories that dominated headlines and that prompted us to write the article. But I think it's something that would really help you build a sustainable business with long-term potential.
Now, this is the US market. Let's say there are people listening. There's a massive opportunity. Maybe they were a bit late, but they're like, okay, I'm willing to move. I would like to do that in, I don't know, let's say Australia, or let's take Europe, for example. Do you think this car wash roll-up mania, it's actually coming to Europe?
Yeah, that's $1 million question, I would say. And here why it's fascinating. I think the key technology that enabled US roll-up boom is just starting to penetrate Europe. And we're really talking about tunnel car washes. They are the mainstay in Europe, in the US, and they're finally catching up in Europe. But they're still not as big as they are in the US. And so, the US roll-up story isn't really about traditional manual car washes. It's specifically about this tunnel system. So these are as I described earlier, they're the automated conveyor belt washes that can process 100 to 180 cars per hour with minimal labor. With that technology, you don't get to those unit economics that would actually justify a roll-up strategy. So you can't take a manual kind of a Tesco car wash in the UK and make a roll-up out of those, right? It doesn't work. I think in Europe, there are some companies that are introducing tunnel car wash systems that are fully automated. And so the technology is arriving. But here's a challenge. If we think about Europe as a market, as I mentioned earlier, what I learned from industry insiders that the consolidation benefits really dissipate outside a certain radius. So if you wanted to do a pan-European strategy, you would run into the same issue as when you're doing a roll up across multiple US states. So most likely, and plus on top, in Europe, you're dealing with different countries, currencies, regulations, labor laws. That's exponentially more complex than rolling up car washes across Texas and Florida. And so my gut feeling is that as the express tunnel technology spreads throughout the continent, there will likely be operators interested in that market. But at the moment, it's not as clear cut as, we wrote an article about the green landscaping where US is also undergoing a massive boom in roll-ups for green landscaping. And it's also to some degree happening in Europe, but with the same caveat is that it's very hard to do it in multiple countries, because in one country, the market is heavily dominated by construction. Another country is a public sector. There's a procurement rules. So it's very hard to do kind of a big pan-European play. And most likely, there will be national champions. But then again, you need to look at every market and see kind of are there enough tunnel car washes to actually build a roll-up of a meaningful scale.
Now, to sum up, Pavel, oftentimes those new opportunities start based on similar research, which you did. So knowing what you know now and knowing that those US celebrities you mentioned, Jason Derulo, Travis Kelch, they're investing in this, and it's an enormous market, 60,000+ stores, fragmented market, with enough capital, time, excitement, and as I said, knowing what you know now, would you get into this or not?
Well, you mean in the car roll-up sector? Yeah.
Exactly.
I think I would say that based on what I learned, I would probably do a Greenfield story, not buying businesses. I actually spoke to a British investor based in the US who did exactly that. So he ran a private equity fund. He bought a few car washes, but very quickly he realized he was doing okay, not exceptionally well. And so he actually ended up starting funds to do Greenfield deployment. And so then you have a very interesting story because you're basically using a lot of data, AI, to find the sites. Think about it as like, franchising McDonald's, Starbucks. You want to find the best sites to sell your drinks, whatever. So they're building those car washes and they're able to get to low teens unlevered yields. You add that on top and you actually get quite a clear de-risk path to 20+% IRRs for building the tunnel car washes in selected regions. So to me, that's a pretty cool stuff. Obviously, you can't do this in many other roll-up sectors. You can't do this in software. You can't build a company from scratch and have it operating at 20% ROICs, right? So I think doing Greenfields is basically taking the same model and then avoiding all the mistakes that everyone made, right? You don't need to fix the site because you're already building the best-in-class site. You can choose where you build. You can control the cost of materials, etc., etc. And you don't need to pay the new build premium. And I know that gentleman has successfully raised several funds. to do that. And this is what I probably would do. If I had the option between doing a HoldCo and a Greenfield, I would do the Greenfield. But I still think that the HoldCo model as a second choice can be compelling, because we will most likely see very big players starting to divest certain regional assets, because as I said, in order for you to really have good synergies, they need to be very, very local. And so if you are a multi-US, multi-site car wash, and you only have 5 sites in Wyoming and a lot of sites in Texas, you're probably better off getting rid of those Wyoming sites. And maybe then I can come in with my HoldCo, buy those sites, and then buy a little bit more and build kind of a 10, 15 EBITDA business, and then hopefully exit to one of the roll-ups down the line.
Okay, Pavel, thanks a lot for your work. I hope to do it again in the future. I learned a lot. I like reading your research work, but at the same time, really enjoyed the conversation and the deep dive. So thanks a lot for doing this.
Thank you for having me.